right, so the stock market had a pretty small day today. A little bit of an up day in some indexes, down in others. Pretty small volume, small range. We had a good couple of days the past to the point where it kind of looks like we're going to bounce off of this low point, that we're done with this pullback and we're going to now bounce up above the moving averages and kind of take off with good breadth as well. Today we didn't really follow through on that. In fact, we kind of missed out on everything today. So, okay, one day that's not a problem. Now, if that one day turns into 2 or 3 by the end of the week, that's a different story. So we're going to kind of break down some of the red flags that are cropping up that would suggest that there's an increasing probability that we might fail at that moving average and make a new leg lower to the downside. So we'll talk about some of those things that we kind of need to see change, especially within the next, let's say the next week, by the end of this week and early part of next week, for us to meet the expectation that we are actually starting a new intermediate rally to the upside. Probably won't be a same rally as what we saw, but a new intermediate run nonetheless. So we'll break down some of the good things we're seeing, some of the red flags as well. Some interesting rotations, not quite the sector rotation that we would expect to see when we're strongly bullish. And then our trade idea in the consumer discretionary space, which is kind of in battle right now. So we'll talk about a trade idea there of a stock that's making potentially its own new leg lower to the downside. We'll talk about how to trade that with support coming up and not much time left in May. So let's go ahead and get started. Today is Wednesday, April the 24th, 2024. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Click on this link right here. That takes you to, we take a look at all the old trades we've done in other Market Outlook videos to see whether we should stay in them or get out of them. We also put on today's trade idea already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up that tab. Hit that like button. Hit that like button there. Again, the more you do that, it gets our content out to all of our followers on those platforms. It's a big deal to us. That's why we always ask for it every day. Our goal is to get to 100 likes on Twitter. So thank you to those who like this day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's go ahead and start off taking a look at the market forecast indicator on the S&P 500. You can see the rally we had today, small rally of 1 single point is all we rallied up today, 0.02%. It is a third straight gain to the upside. We do have light green shading, which means that the intermediate line has crossed up above the 20th percentile, just barely, but it did cross up above the 20th percentile. The near-term line made its way up to extreme highs, up above that 90th percentile. So very good move up to the upside for the near-term line. Of course, a dip down here on the momentum line, down into bearish territory. That's to be expected when you have a small range. We ended up with a lower range. Remember, a smaller range is actually a really good thing. Now, granted, we'd like to get through the moving average first before we start getting those smaller ranges. So we'll see if today is just a one-day phenomenon. If you take a look at the NASDAQ 100, which is actually getting beat up quite a bit right now in the after hours, down to 421 because of the meta news. But if you take a look at its market forecast, again, very similar to the S&P 500. Strong move into the upper reversal zone with the near-term line, momentum line down into the bearish territory. Your market sentiment's a little bit further lower on the NASDAQ 100. It's at below 70 now, and you don't have the light green shading yet on the intermediate line. Take a look at the Dow Jones Industrial Average, and you can see, again, something similar. Near-term lines bullish, momentum lines more oversold, or at least deeper in bearish territory, not quite oversold. You do have light green shading. The intermediate line is up above the 20th percentile, and its market sentiment lines is barely in bullish territory. So it's really been more bearish there. And then finally, your Russell 2000 also is even closer to dropping below 60 than the Dow is on the market sentiment line. Its near-term line barely getting into the upper reversal zone. Again, remember the S&P got above the 90th percentile. They're also barely holding right above the 80th. And again, you don't have light green shading yet. So you're still below moving averages. We're still a couple of days away potentially from getting a bear tag, kind of like this. Either one of these two, right? Either it starts the intermediate run to the upside, or it fails and we have a new leg lower to the downside. So, but as a small range, it's kind of a little bit of a pause, a little bit of a hiccup going into what is potentially the rest of the week here of gains. Now, again, we still have to digest the meta news and the impact it might have, at least on the mega cap influenced indexes like the S&P and the NASDAQ. You can see the Russell 2000 in the after hours is not down nearly as much because, again, not impacted by what's going on with the meta news. All right, so if you take a look at the weekly chart here, you can see, again, we do have a lower close on the weekly Heikin-Yashi candle. We are below the 10-week moving average. The PPO is falling, but we don't have a lower low point. So that's kind of the new, or the key level to watch. That low point of 49.50. We're currently trading at 50.71. So we're more than 100 points away from getting a new low point here on the weekly candle. So again, it's not a reversal, but it's a very early sign of reversal. When you for example, like right here in 2023, you got the lower close, smaller body, and a higher low, and then we did get some bullish candles immediately after that, and you kind of see the same thing over here as the lows were just barely lower and the closes were lower, and then we finally got the higher low with the transition candle. We worked our way back up to the upside. So it would be a very, very good sign for the markets if we were able to maintain that higher low point for that weekly candle. If you look at like the Russell 2000, same thing. The close is actually a lot closer to being bullish, and we've already crossed the size of the candle, has crossed above its moving average here. So that's a positive development too. If you take a look at the 3 green arrow charts, you can see we have 3 red arrows on the S&P and the Qs. The diamonds has 2 green arrows now as the MACD has turned up. The Russell 2000 has 1 green arrow here as the MACD is turned up today, and your stochastics may be one more day from producing a green arrow there. So green arrows, right? We don't have 3 greens yet because we got to get that bear tag and the cross above the moving average, but at least we're not light pink shading anymore. And just to kind of give you an idea, when you're bullish here, you can go without shadings for quite a bit of time, right? So you can have a red arrow and still be kind of going higher, but not be bearish, right? So 1 red arrow, but not 3 red arrows in the red line. When you're bearish, you don't typically do that, right? You don't get nearly. You're either bearish or you're not. You either have 3 red arrows, or you don't usually have just 1 or 2 red arrows for very long. You either turn 3 greens, or you turn like here, or you turn right back around. Let me zoom out so you can see. In 2022, you turn right back down to 3 reds, right? It's not very common, and usually, the reason why is once you get to the moving average, we either get 3 greens or we fail, and we don't. In this case, we don't get to the moving average and we turn right back down. So it's not like the bullish 3 green arrows. So like right now, we don't have 3 reds on those 2 indexes. So again, either we are very close to getting 3 greens, which would be the bear tag and the reversal, or we're most likely going to fail here pretty soon. Again, potentially tomorrow if the meta earnings leads into more of a risk aversion trade than what we're currently seeing. Again, just for the mega cap influence indexes here tonight. Let's take a look at some of the other oscillators here. So we'll start off with like the DMI. You can see the DMI pattern. You are below 30. You're not below 25 yet on the negative indicator. We got to get, for us to change this trend around, we have to get below 25 on the negative indicator, and you definitely have to get at least above 20 on the positive indicator. We're nowhere near that happening. Of course, if you look at like the diamonds, which has been a little bit more bullish here, more bearish originally, now more bullish here in the short term. We are below 25 on the negative indicator, but still not even close to getting above positive 25 on the positive. So, that's the kind of change we need to see there. Looking at the RSI and the CCI, you can see we are not in bearish territory, but we're still not above that chart's midpoint yet, and we're still not above 0 on the CCI either. So we're not we're not bullish enough yet to really kind of clear out this bearishness and start a new leg to the upside, a new intermediate run to the upside. You can see we're flirting with intermediate trend strength. You're a little bit above the -2 level. But you're a little bit above 65 too. So you're still in the cloud. You're still below these lines. But it also kind of goes to show just how close we are to changing from kind of this bearish pullback to more of a bullish opportunity here. If you look at, so now let's take a look here at the Bollinger Bands and the Keltner channels, and you can see again we are still in the lower half, but that's again we're losing that bearish momentum, so we're at least moving in the right direction there. Taking a look at today's intraday move, you can see we finished lower than yesterday's high point. We did get a higher high and a higher low. Smaller range. Again, we don't like to see those smaller ranges so quickly. You can also see we're moving in the right direction here, so at least we're not getting new lows, and that sets us up for a change in direction here sooner rather than later. Then you look at the let's see here, today's volume and trading range, and again below the moving average, you don't want to see below average ranges and below average volumes on the move up to the upside. So again, not the best sign there, and we do want these to start heading lower, but not so not like right now. You can see when you're below the moving averages, they turn lower. You just tend to bounce back up. You got to get above the moving averages for it just to continue lower to the downside. And then finally, if you look at the VIX, here's the VIX. Sorry, down here. Remember that VVIX dropped really, really low. The VIX is back below the 95% mark now, so big drop on the VIX there, even though you're still above 15. And as I mentioned before, the VIX dropped down here, still below its 17-day moving average, still above the long-term averages. Clear the 15 level, you're going to be below those averages, and you're back to like now again, beginning stages of a new intermediate rally to the upside. All right, now let's take a look at what's driving the price action here today. We'll zoom in on just today and how things performed here. We'll go right there. You can see the Qs still did okay, but the higher rates with TLT down, that means rates were up today, of course. Higher rates really putting pressure on the small cap index. It was down 0.5%. The Qs were up. Of course, the Qs won't be up here in the after hours, but they might be by the time we get to the open tomorrow. Who knows? The dollar was up. Commodities were down slightly, just a little bit. If I were to zoom out to the week, to the entire week here, you can see the IWM actually had the upper hand going into today. Now the Qs have the upper hand, but they're still both up pretty strongly for the week. Gold is down significantly. And now keep in mind, gold has been parabolic, so not surprising. We talked about that parabolic nature in prior videos. It's down quite a bit, but just again, in context of a big, large move, that's not very much. And like I said, bond yields were up today. The dollar was kind of doing it. It's down for the week here. If we take a look at the the charts. So we look at the dollar index. You can see the pullbacks. So we've had a pullback before. So here we are just so far, just pulling back again, very similar. As of right now, holding the 17-day moving average for a support. The commodities index had bounced off that 30-day moving average yesterday. We're trying to get back above that 200-day after a brief little pullback. MACD and stochastics are down. We'll see if they roll up. Of course, a big function of that is what happens with crude oil. Looks very similar. It is above its 200-day moving average. You can see its oscillators are also trying to turn up as well. You need to get above that 8 and 17-day moving average to really get that turnaround going. Of course, when you look at the 10-year yield, look at the 10-year yield here. You can see that that bounce up. So it had the big drop yesterday, and it bounced back up today. Here's the rally up higher. The MACD is below its moving average. We had a good run. We're at the top of that run right now. All the oscillators are pretty bullish. So we'll see if that we're back above 60, or it had been above 60 on the RSI here. And you can see the correlation has been relatively positive with the stock market. The rising yield, again, not as positive as it was, but has been relatively positive here, and we'll see if that continues to be the case, especially if we break up above here to a higher level, right? If we get up to up closer to 5% like it did last summer, late last summer. I did have a few charts up here, one of them being the ratio of XLY to XLP. I tweeted out about this earlier today. That ratio chart has broken the 200-day moving average for the first time in a few years. You can see if I zoom out here, it breaks down below this when you are in these kind of risk aversion plays. You had that as well in 2018 and a little bit in 2019 when we had the interest rate cuts, the mid-cycle adjustment there, and then of course with COVID. But that's a pretty significant break. You can see the long-term. I mean, that's how close we are to a death cross, which again is, you can see the ratio is traditionally bullish or positively correlated with the S&P, so not necessarily the best sign that we're breaking below that. The other tweet I posted out today too was you are just starting to cross off of some multi-year lows. The relative strength line of XLP to SPY crossed above its 50-day moving average. Starting to move up here on both the relative strength and the momentum, and we're rising. So we kind of did that in late 2021 where they both rose, but then as it started to drop in 2022, the relative strength continued to rise, and that's something similar I see right now. We're at multi-year highs here for XLP because we rallied so much from October to the end of March. We rallied so much in XLP, but we were on a relative basis declining so much over that same time frame. It's rare to have, even like you can see some of these other big moves, like this big rally right here, we were on a positive basis relative to the market. Same thing here, big rallies. These two big rallies were on a positive correlation, like the ratio rallied. So here we are, a big rally up, but the ratio didn't rally. It like trended lower. And so now the concern is if this ratio continues to go up like it did in 2022, are we going to be able to continue to really push up to new multi-year highs, or are we going to do what we did here when we got to this first peak and then we fell throughout that rest of, that summer of 2022. And then the ratio pulled back but stayed on a bullish trend here. So that's the concern that would coincide, this relative strength of XLP would coincide with weakness in the market and volatility in the market, again, like we saw multiple instances there in 2022. Let's take a look at the sector rotation. I had this chart up here. This is the daily chart. You can see XLP, XLU, XLV. So you have your safety trades have the highest momentum. They're moving up to the top right. XLK and XLY are in a lagging category along with real estate. XLC, XLE, XLI kind of moving in the weakening category. These cyclical areas, XLB as well, it has now gone from weakening to lagging. So we are rotating towards safety right now in the markets. Even with rising yields, that's still not putting pressure like it is on real estate. It's putting pressure on real estate. It's not putting that pressure on utilities. So it kind of goes to show the safe haven nature of the markets right now. You take a look at the comparison of the U.S. sectors here today. We'll zoom in on today. And you can see staples did really well. Now, so did discretionary, and utilities did pretty well, but so did technology and real estate. So on a one-day basis, they're doing okay. But as you saw, they're starting to lose some of that momentum, even just going out, like say the last 5 days. Utilities and staples are by far the outperformers, along with financials, and XLK is lagging, and XLY and XLC are kind of matching the market and also lagging behind all these safety. Even healthcare is outperforming. So a big move higher in the safety trade suggests again a rotation away from. Remember, we've had this big strong return of 27% without a 2% decline, right? A big record return here. And even during this 5% decline, we still haven't had that rotation yet. If you look at, from the time that we peaked on March 28th, so starting on April 1st, starting on April 1st and working our way lower. We'll just go to this chart here. Here, 1 second, let me get this over here to April the 1st. You can see that technology and communication services for a while were still outpacing despite the decline. But now, of course, technology has really started to move lower, and staples now is overtaken. Utilities have overtaken, and staples have overtaken XLC, and energy is still. So those are three areas that typically outperform during weakness in the market. And it's really been the last week from last Wednesday on that they've gained that upper hand over the cyclical areas that had been doing okay during the initial decline. I mean, real estate was down the most, financials were down the most, healthcare was down the most. Those were the areas dragging the markets down. When you look at the 12 grid for the U.S. sectors, of course, you have the S&P up there in the top left. Technology, discretionary, real estate kind of all look very similar. XLC looks similar, just not to the same extent that you have on these other two. Materials, healthcare, kind of matching with the dark pink shading and the red line, and some of these others a little bit more bullish than other utilities, and staples are kind of showing bullish patterns there, and energy kind of showing a dark green shading and the green line a bullish pattern there as well. So there is a rotation. It's not the rotation that we're hearing a lot about, like that strong breadth rotation. We're not really getting that. As you see, the highs and lows is up to zero, but not quite yet strongly above zero. The number of stocks above their 50-day moving average are up, but not up enough to avoid a failure, right? We need to get above that moving average to get a stronger move over the past so many days, and we haven't seen that yet. Again, the McClellan oscillator here rallied up to the upside, but hasn't gotten back above that positive 35 level yet, which is kind of what we need to see to really change the trend back to the upside, especially after hitting minus 100 onto the downside. So breadth is improved, but it hasn't improved enough to really change the trend yet. And in fact, it's kind of more set up for leaning towards that failure. So that's why it's really important these next couple of days that we finish out the week tomorrow and Friday the same way we started the week, and that today kind of just being a one-day anomaly. All right, that brings us to our trade idea of the day. It's on Wayfair in the consumer discretionary space. We're looking at the weakness here in discretionary. You can see after a couple of good days, especially yesterday, we completely reversed and then some those two gains. In fact, we finished the lowest close here of this little rally to the downside. Near trim line got into bullish territory on yesterday, but dropped back down. Intermediate line still bearish. So you can see things are not looking too hot for Wayfair. You can see where we've closed now below the 40-week moving average. We're that close to getting a death cross again on the stock. Obviously, you have Three red arrows right now. We are below the point of control. The 8 and 17 have crossed below the 200-day moving average. Now you just need a 30 to cross below 50. You'll have everything kind of in alignment there. Again, really that close to a death cross, producing a death cross here. If you take a look at some of the other oscillators, we are above 25 on the negative indicator. You're back below 25 on the positive, though it would be preferred to get below 20 and let the positive get above 30. If you look at the RSI and the CCI, you can see we're back below 40 in the RSI. We're still below 0 on the CCI, so still at bearish levels on both those indicators there. If we look at the Ichimoku cloud, we do have an intermediate trend strength. We're above 65 or below -2. We're below the cloud. We're below the green and blue lines. The green's well below the blue lines. We have a negative rate of change. So you can see how we're piling up a lot of bearish evidences here. As was mentioned, we're below the point of control. We are in the lowest quartile of the bandwidth. It's rising outside of the Keltner channels. Not quite out. We haven't closed outside it. But we do have that gap to kind of fill in between the two unless things really start to slow down there. So we decided to do a bear call spread. Again, considering that we don't know how much further it's got to go. It's already started to trend lower. You're around the point of control there. You haven't really broken major support. So we set up again selling the. Let's see here. We sold the mid 30s on the delta up to the downside, and then then the 61 for. So you can see we got a pretty decent credit. We need to get at least for $1,000 of risk, $300 of reward. You get a 30% return on risk. You get $350, which is interesting because when you look at the 35 delta here on the call side. You're not getting very much money. Let's see here. You're right around the 48 cents, 45 cents now. But when you look at it on the other side of the equation, you're getting over 70 cents, or about 70 cents. So you're getting a lot more credit. There's a lot more risk of the stock and its earnings pushing the stock down than it is going up, and hence why we did the bear call spread. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow me on Twitter and Facebook, and like us there as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.